Hello friends, hope you're doing great. Welcome to our channel. Today we'll cover commodity options versus index options and few examples related to it. Quick disclaimer, this is for education purpose, no investment recommendation and it's your money, so please be careful. First we'll discuss commodities option. Okay, so in if you still want to know what is option, you can refer our other videos where I have explained what is option and what is call versus put and all the details. And in this lecture we'll focus on the type of options like commodity options and even index options. So I'll start with the commodity option in agriculture. One of the example is cumin seed or jeera. So you see, as a buyer, option buyer, why he would want to, as I mentioned earlier also, why he would buy the option. One reason is he want to reduce the risk, hedge against flood, drought, grain gets spoiled. So he's actually looking for a kind of insurance. That is first part. And the second reason a buyer buys option for jeera for his agriculture crop is because he want to save himself from price fluctuation, because these crops are seasonal crops. Once they come in market, the supply is higher, so they want to save themselves against the price fluctuation also. Okay, on the other hand, seller aims to earn money, to earn premium. They are the risk takers. Okay, and cumin seed is basically a flowering plant from the family of Apiaceae, and this Jira option is available on NCDEX, that is National Commodity and Derivative Exchange Limited. Let me quickly walk you through on the site as well, so that will help us with an understanding. So if you see here, and you should actually go and see all the details related to it. So it's very clearly defined all the terms and conditions. So I go here on the site of NCDEX, I open options, and then you can see the options are available with expiry of November and December, that is next 2 months. And then type of auction, whether I want to buy a PE, that means I want to uh, take up or buy a put, or I want to buy a call. Okay, because I am a buyer as of now, as I'm working as a what you call a farmer who want to hedge his risk. On the other hand, if I am a seller, then I'll be selling the PE or C. Okay, generally sellers are the bigger institutions or speculators who want to take a risk. You can also see that commodities, you have other spices like turmeric, coriander, jeera mini, and there are many other. Okay, so now they add the brochure here, they add the future chart, option chart. So you come here, and only one task I give you is read this brochure. It will give you an idea how they execute the trades. These are pre-written trades. Okay, option on futures on Jira, option the game changes, right? So let me quickly walk you through important terms here in my presentation. First of all, whenever we go for an option, right, it has an underlying, that is Jira Unja, that is a quality and a name of that particular Jira commodity. What is unit of trading? Here, unit of trading is 3 metric ton. Delivery unit is minimum 3 metric ton. Maximum order size, which is freezed at 150 metric ton. I am referring to NCDEX, right? For other exchanges, this may be different. Okay, then I go to the different other matrices or other details, like what is a strike interval, that is 400. Every 400 price difference, it will change the strike number of strike. One is your ATM, then plus 10 minus 10, that is out of 10 out of the money, 10 in the money. Okay, please understand, most of the options in India are European option, to be exercised only on the day of expiration of the option contract. So if, as you have seen on the website, it was on 19 November. So then this option can be exercised only on the expiry date, that is on 19th of November. Okay, so that is pretty much about Jira option. Likewise, we have a commodities like a metal. So you have options on copper. Now, if you see copper again, there is a buyer who want to reduce the risk. Maybe he is importing copper from other country and he want to reduce the risk, or maybe he is someone who is producing copper and then he want to reduce the risk. He is a miner, maybe a miner who mines the copper. On the other hand, we have speculator who is a risk taker and ready to sell the option contract, right? And you can get the quotes over here. So we go to MCX site and you see copper, and you see the copper price was 996, which was down 0.14%. And if I go to options, then you see that we have multiple contract, like three contract: 24 October, that is within a day or two, and then 21st November and 20. So three expiries we have, and this is a call and this is a strike price. So you can see, because we have seen the price was around 900 something, so you have here multiple strike prices for that option, right? And then you have over here expiry date, because I have selected expiry of 24 October. Okay, let me just quickly increase the, okay, then you have other numbers like volume, that is 12 lots, trading unit, that is 2500 kgs, and then OI information, changes in open interest, that has increased. All the details we will study in our different videos, but today's topic is to focus on what type of options we have, right? So going back to our presentation, so you can see copper unit size is 1 kg, location is Thane, that means the delivery point would be Thane. Okay, and when I was taking the strike price of 1040, and it was available at 7.50, which was increased by 4.62 in a day. See the difference, right? The jump 160%. So that's okay. Few important details about this particular option: that symbol is copper, underlying shall be copper future contract. So please understand, this option on MCX is made on top of copper future, not on a copper underlying, rather on a copper future. So description, it's option on a copper future. So first we have created a copper future, and then on top of it, it is not on copper spot. Okay, and option type is again European, call or put option. Contract will be available as per contract launch calendar, right? And then trading period Monday through Friday. And okay, so pretty much you can refer this. Let me go back. Copper 2500 kilogram futures as underlying. So the unit weight is 2500 kilogram. Okay, now if you see here, strike is 7 in the money, 7 out of the money, and 1 near the money. So in total we have 15 CEP, or rather the exchange provides you 15 strike prices. So you have got 1 ATM, 7 out of the money, 7 in the money. Strike price interval is for 5. Now same way you have other commodities like crude oil. Okay, you may have commodities like natural gas. You can see here you have silver, you have gold, you have gold DM, silver M, zinc also. So there are many commodities which we trade in, right? Okay, then the next topic comes is index option. In index option, I take an example of Nifty 50. Okay, Nifty 50 is basically one of your index created by NSE. People do have, so Nifty 50 has a spot price, that is price on cash of the index. Then it also has future price, and then it also has Nifty option. Nifty option is a derivative contract that gives the buyer the right but not the obligation. That's the beauty of option, right? To buy or sell the Nifty 50 index as predetermined price on or before a specific expiry date. It is widely used for trading, hedging, and speculation in Indian market. Same concept, that buyer is basically trying to reducing the risk or hedging his existing portfolio. On the other hand, speculator is a risk taker and he is focusing on earning some premium. Most important thing when we do trade in Nifty 50 options is the option chain. In option chain, it gives you a strike price. So if today's price is 25,500, then that is your ATM. Okay, that becomes your ATM. 25,900 was yesterday, so that's your ATM. And then you have out of the money and in the money. Okay, then you have call section and the put section. So best thing is you go to NSE site and read this option chain. We'll have a separate video where we will analyze the option chain. Okay, now few important matrices around Nifty 50. Nifty 50 option is based on underlying asset, that is Nifty 50 index. The lot size of this, that means one contract is of 75 units. Okay, so if I want to buy a call or a put, I have to buy 75 units. That forms a one contract. So if you see open interest of 1 lakh contract, that means those are 75 lakh units. Okay, then in this we have two types, one is call option and other is put option. Call option means right to buy Nifty at a strike price. Please understand, when I go for a call option, that means, and I am buying long call option, that means I am aiming the direction of the market would be higher, rising. When I'm going for put option, that is right to sell Nifty at a strike price. When I buy a put option, that means I am aiming or focusing, or I am having a mindset that market will go down. So I am selling it now, or I am taking a contract or option that I will sell in the future before the expiry date. Okay. Style is again European, that is can be exercised only on the expiry date. Okay, expiry may be weekly, monthly contracts available. Premium paid by the buyer to the seller for the right they avail. Okay, so that's the Nifty 50 option. Thanks a lot, and please like, subscribe our channel, give us the feedback or add the comment. And if you have any query, please feel free to write in the comment section and we will revert back to you. Thank you very much.